Hi there. In this video, we will continue our discussion about the red flags in fraud detection. And just to give you a quick overview of what I mentioned in my previous videos, that number one, we need to differentiate between fraud examination, forensic accounting, and auditing. And if you remember, we say fraud is presenting false statement or presenting errors with intention to get some benefit for the individual or the organization. Taking this fraud into court system on litigation, this is forensic accounting, where we go into litigation, intermediation, and some kind of resolutions. And the forensic accounting can cover business issues as well as the personal issues like divorce and insurance. And then we said in auditing, the external auditor comes at the end of the year to check the corporate governance structure and see how the board of directors are setting the tone of internal control and working to build up a policy that doesn't tolerate the fraud, and ensuring that the management use the framework of Committee of Sponsoring Organization, COSO framework, for internal control. So the board of directors, they come on the top of the ladder to set the policy and ensures the compliance with COSO framework. Then the audit committee will start to review what the management is doing. And to do that, the audit committee, they usually make the internal audit department, because the internal audit department should report to the audit committee. And the internal auditor usually comes on a regular basis every quarter to check that the internal control system is working and report to the audit committee. And we mentioned that this governance structure is evaluated at the end of the year when the external auditor comes to check the internal control. And if the company is public, the auditor has to issue an opinion on this internal control. The opinion could be unqualified, could be qualified, could be adverse, or could be disclaimer. And we mentioned this in the previous videos. Today, I will talk mainly about the red flag, which is the key point, which is mentioned in this chapter. So what are the red flags that might be helpful for the auditor or the fraud examiner to find out some hints that might lead for the fraud investigation? First of all, the fraud examiner or the auditor, they usually go through the financial statements, the financial records, the accounting journals, and try to see consistency in the events, like purchases are working consistently, or sales or assets. And if they find exceptions during the year, we call it accounting anomalies. And the auditor has to catch the unexplained anomalies. Maybe the company did very good sales in 1 month, but they didn't justify this unexpected sales. The auditor usually take this one as a red flag. Second, the weakness in the internal control. The auditor might take this as a red flag. So if the auditor try to test the internal control and find there is no segregation, which means one person is doing multiple jobs, this can be a red flag that the auditor has to investigate. Another one, trying to compare the financial information with non-financial information. And this is a good red flag. So for example, if the economy is going bust and the situation or the market is not really good, but the company is making unexpected profit. So we say, how can the company is doing profit? Meanwhile, the economy is not going really well. So here we compare financial data with non-financial data like the economy standard. And then we try to see the relation between those two. Other thing, if the auditor or the fraud examiner found that some people in the company, they have very expensive cars, or he heard that they live in very expensive houses, or they travel a lot, Meanwhile, their salary is not that big enough to accommodate all these expenses. So we call it observing the extravagant lifestyle of certain employees, because how can an employee with a small salary is able to buy an expensive car and so on. Another one, observe unusual behaviors, like the way the employees, they are talking to each other, the way the employees come and go from the company, if there is any camera, any security, and so on. This can raise red flag for the fraud exam. And here also, anomalies communicated via tips and complaints, which means the auditor can collect the red flags either by observation or by hearing what the employees talking to each other, or by getting phone calls or letters and so on from the whistleblowers. Once the auditor collects some red flags, it doesn't mean that the fraud exists. So please remember, red flags can be leading for fraud examination, or it might be incorrect. So we don't take the red flag as an evidence for fraud transactions. It is a hint, but it's not an evidence until we document it and we examine it and we go through the financial process and the examination process to see there is some kind of fraud. Once the auditor collects the red flags, then the auditor has to go back to the definition of fraud, which has the 3 pillars, and try to identify the red flag to which one of the 3 pillars, as you can see them here on the screen. The first pillar in the fraud definition is motivational or pressure. Is there some kind of incentive for the management or the individual to go for a red flag? And here, for example, the management. Does the management look for the short-term achievement or the long-term? Short-term, it means the management might be interested to show high net income at the end of the year so they can get bonus on the following. The auditor has to check the motivation or the pressure for the individual or the management. Second, the auditor has to check the internal control. If the internal control is weak, this one we call it situational factor, which means the people might abuse the situation of internal control weakness and try to commit fraud. The third one, the behavioral, which we call it justification, that is there any kind of justification the management or the individual might provide to commit fraud. And here we call it the tolerance of risk. If the management doesn't tolerate the fraud, this would be a good hint that even if motivational and situational factor exist, but the internal control will stop and the management attitude will stop the fraud from being complete. How we use the red flag to detect the fraud? As I said, number one, we should look for documentation. We cannot take the red flag by itself as an evidence for fraud. We have to go for documents to support the red flag. The other one, the documentation, it could be wrong, or it could be altered, or it could be fictitious, and this would be the first hint to go through more investigation. So if I hear that this client that has lots of invoices is not a real client, it's a fictitious client, I say that's fine. Now let me go through the invoices that has been made to that client. If I find the invoices are not original invoice, but they are duplicated invoice, I say, so this client, I don't know if he exists or not, and the invoices made to this client are not original. And then we see, does the transaction and its reflection in the financial statement make sense? Then I go to the financial statement and see, these invoices, they make a big chunk of the revenue account in the income statement. If I see that the sales that has been made to that client, they constitute 10-15% of the revenue. Then I say, yes, this means there might be fraud because of the red flag, the documentation, the alternation that happens, and the impact on the financial statement. Then does the transaction make sense? I say here, if the company is looking for short-term income and they would like to get bonus in the following year, yes, it makes sense. So the company, they try to overestimate the revenue to show more income and get some bonus. And then does the totality of this and similar transaction make sense? If I say here, the total amount of sales to that customers is way above all the other customers, then I say, yes, this can make big sense for inflating the income so the management can take a bonus at the end of the year. Does the transaction have proper approval and a proper authority level? And here we have to go to the credit department to see who approved the sales to that client, the fictitious client. So you can tell here that the red flag is just the beginning of the investigation process that will lead me to see if there is a fraud or if there is no fraud. And finally, does anything else about the transaction or its nature appear suspicious? As I said, the amount of revenue is inflated significantly by the sales to that customers. So here we say that the red flag, it's just the beginning point that will help the auditor or the fraud examiner to go through the investigation. As I mentioned, remember the tips is very helpful. But remember, some tips might not be true. It might be error, it might be rumors. So we listen to whatever we hear, but we have to analyze it and don't take everything at the face value. And the tips might be helpful, as you can see here, the ACFE, which is the Association of Certified Fraud Examiner. They made a report back in 2016, and I think you might find it on their website. It says the tips were leading to detect a fraud in more than 29.6 cases among the small organizations and 43.5% in large organizations. So the tips are very helpful, but remember, it doesn't make 100%. It's just a significant percentage. So tips and accidental discovery combined, they make more than 50% of all fraud detection. On the other hand, tips and complaints can be false. There is no guarantee that every tip we hear and every red flag we see that is true. It could be false. And sometimes the employees and the people, they have tips, but they don't disclose it to the auditor, especially if the employee doesn't have long-term contract with the company. In this case, the employee is afraid about losing the job, and because of that, the employee doesn't disclose the fraud. The other one, the whistleblower. Whistleblower, which means somebody might call a hotline and report some kind of cases or incident that can be leading for some kind of fraud investigation. So whistleblowers or fraud hotline are good tools to collect tips because they are easy, unanimous, and the person who calls or give some information can give more details because the person who receives the call doesn't know the caller. In this case, this might be a good way. And most of the company, they have whistleblower hotline. Once we get the red flag, as I said, we usually check the lifestyle of the different employees. And if we are suspicious about certain individual or certain manager, then we usually check if the management is taking good amount of salary to afford the lifestyle or not. If the manager has lots of very luxurious assets like expensive homes, like travels, like expensive cars, all this kind of hens can give a good analysis about the lifestyle of the person, and we match this against the salary to see if the manager is able to cover up all these expenses. The unusual behavior, and this is another issue, that when the fraud examiner or the auditor start working on the examination, he will see and notice the reaction from the fraudster. Some people are afraid. Some people, they start talking secretly to each other. And this can give a hint about the behavior of those employees to the examiner. The stress also changed the fraudster behavior. It is difficult to discover fraud from those clues alone, because some people, they make good camouflage and you don't see any hint on their reaction. And some people, they know even the technique of fraud investigation, so they try to counteract against all these reactions to make sure that nothing will be discovered. The auditor here has to go back and check the documents. As I said, we usually check the behavior, but we check the document to make sure that there is no unusual transactions during the year or unusual anomalies in the records. So transactions or financial statements that do not make sense, those we call them anomalies. Transactions that are too small or too large. And you might wonder, I have no problem to investigate big amounts, but why should I worry about the small amounts? Because some fraudsters, they are very smart. And instead of showing you a huge amount that can catch your eye, then they make lots of small amounts that when you see them, you say, well, okay, that's completely normal. But remember here, if the small amounts is repeated for a certain individual, like a customer or supplier or employees, then this might lead to fraud examination. A pattern or breaks in pattern. For example, if we make sales to a certain client once a month, why do I see like sales to the same client maybe 3 times a month or 4 times a month or 0 a month? So I check the pattern of sales to a certain individual, and if I find either unexpected high sales or low sales in a certain period, this might be a good catch that can help me to start investigating about the matter. Analytical anomalies are common and should be pursued until fraud is discovered. So we keep running these analytical anomalies. The accounting anomalies, as I said here, some people, they cook the books. And what do you mean by cooking the books? We try to work out through some journal entries that do not have cash. And this is a very good point that can be covered by the fraudster. So for example, if the company is selling products and they make warranty on the products, maybe for 2 years or 3 years, so we make a percentage of maybe 5% of our sales might be returned during the warranty period, either for repair or for replacement. So the company usually create a journal entry for contingency. We say debit warranty expense, credit warranty payable. And here we create an expense that doesn't have cash, but this expense will reduce my net income. On the other hand, the warranty payable, this will increase the liability. So sometimes the management, they play with this non-cash transaction to overestimate the income and underestimate the liability by playing through the percentage. And this is what we mean by the accounting anomalies. Entries that reduce liability while simultaneously increasing a revenue account should be red flag. And good example, warranty expense and warranty payable. Then we see the, apart from the financial records and the red flags, we check the internal control environment to see if there is any irregularity or weaknesses in the internal control that doesn't discover the fraud or deter the fraud. So we check the segregation of duties. It means that the job is made by 2 or 3 different persons to make sure that if one person made an error or fraud, there is another person to find it out. Another one, authorization for the transaction, adequate documents, so we don't see only invoice without purchase order or without shipping record from the warehouse. We need to see document as much as we can to prove that this transaction is true. Physical control, like having cameras, like having security guard, passwords, independent check, that there is independent check either by the manager or the internal auditor during the year to ensure that the internal control is working properly. Also checking the economy of the company is very good, because here the non-financial number like the economy situation, the inflation, the increase in the tax rates, all of these have big factor to tell if the company is making fraud or not. So as I said, in the bad economy, if I find the company is making unexpected profit more than the competitors, then I say there might be a fraud here. So the non-financial information is very powerful. And here we break sums down to quantity and price. As I said, the sales. We compare why the sales is increasing when the economy is bad. Was it more sales in quantity or higher prices charged by the company? And then we make some kind of correlation and try to do some analysis. Using the red flag as a basis for further investigation, as I said, once we find the red flag, once we see is it in the financial accounting or the non-financial issue, once we have documents, once we find weaknesses in the internal control, we can start to run our fraud examination. And by the way, almost all the cases of fraud are unique. There might be some kind of similarity, but in general, the fraud cases are different from one company to the other. We consider the red flag in context of the circumstances of that situation and what causes transaction to seem unusual or irregular. So we have to see the reason. And we use evidence, and I'm going to talk about the evidence in the next chapter to develop other reasons. Part of the fraud examination is how to find the relevant and reliable evidence that can help the fraudster, help the examiner to build up a good case that can be presented in the court. And then we see the motivation of the individual or the management who did this one. Then, as I said, the evidence here should consider the element of the fraud. And I hope you still remember the element, which is the pressure or motivation, the opportunities, and the justification. But remember the process of the fraud. The fraud starts by stealing the item, then concealing the item, then converting the item. So for example, we might steal a computer and then we hide it by making a journal entry that this computer is depreciated. And then we sell the computer and get the cash. This is the process of the fraud. So here we have to check the cash, we have to check the concealment and the conversion possibilities. And as I said, this is the fraud triangle, talking about the three different elements of the fraud and how the auditor or the fraud examiner check the internal control issues. And we said in my previous videos that we need to check the reason why the fraudster is making fraud or fraudulent case. It could be for searching for money or ideology like Robin Hood, or coercion is to use his authority, or trying to live beyond his or her means by living a luxurious life. Other consideration is if it's for the management, we check what are the most promising investigative techniques. So we need to see what the techniques we should use for our investigation, the methods and the approaches that will most likely result in a successful investigation. And investigating a case that is made by the management is more difficult because the management usually make a good coverage so the examiner doesn't find it out. So the examiner has to be very clear about his goal, his plan, what should be done to discover the case. And then we make assessment for the fraud risk. And this is like a longer process. First, we start identifying, understanding, and evaluating the control environment. Number one, when we start our assessment for a fraud risk to be existed or not, we have to look at the control environment. Then we check the process or the operation and consider differences in both processes. For example, how the sales transaction is made. We have to go through this process. First, we receive the order from the customer. Then we check the credit history of that customer. Then we check that the customer has a good, clear history. And then we start to check the warehouse to see if we have the product that has been ordered. And then we ship the order and make the journal entries. And then we send it with the invoice to the client and collect the cash. The examiner has to check this process and any other similar process in the company. Then we identify the process owner for each significant process. For example, the sales order is made by whom? The credit approval or authorization is made by whom? Those people, we call them the owners. And then the warehouse keeper or the invoice that has been made by the billing department and the goods that came out from the warehouse, who made it? Those are the owners of the process. And then we review the past fraud experience within the company. If something happened before, identify how fraud may occur in each process. If it happens, how could it be? And then we identify the parties who have the ability to commit the fraud. So if the transaction here happened in the sales process, we say, who might be the person that commit this fraud transaction? So for example, the warehouse keeper might make a secretive agreement with the client to send him goods without invoice and split the price of the product between them. So he will take 50% and the client will take 50%. This means the client will buy the same goods with 50% discount. Some people might feel comfortable to do so, getting the product at a very cheap price without invoice, and they can handle the paperwork. So in this process, the warehouse keeper is the party who commit the fraud. So we have to check who might be involved in the fraud. And then we check the likelihood. Yes, there might be a fraud, but if I see cameras in the warehouse, if I see security guard at the warehouse, if I see a password on the computer in the warehouse that is only given to the manager, if I see multiple storekeepers sitting in the warehouse, those are securities or different types of security that can reduce the possibility of the fraud to happen. And then we consider the likely methodology to commit and conceal the fraud. If this happened, what could be the way that the fraud has been made? Does the storekeeper came at midnight and do this? Does the storekeeper came during the weekend and commit this fraud? We check all these issues. Then investigate the characteristics of potential fraud manifestation within each process. We have to check what are the characteristics. For example, if I see that the storekeeper who has a very low salary, out of a sudden, after this transaction, he made a very expensive trip somewhere in Europe. Meanwhile, he cannot afford it according to his salary. So I say, maybe because of these fraudulent transactions, the fraudster got unusual income that enabled him to travel. Then if we find, we might do some kind of remediation fraud risk scheme by designing control activities. The last point here is the targeted fraud risk assessment in the digital environment. Risk assessment in real world it could be manageable, but when we come to the cyberspace, then it becomes harder. It's not impossible, but it is hard. So in the digital environment, the electronic environment captures millions of transactions that could happen on a daily basis or semi-annual or monthly. So here we have to assess the risk using different tools. And one of them is the computer-aided auditing tools, which we call it CAT. And this will help us to extract the data and make some kind of analysis. So for the digital environment, it has its own tools for discovering and assessing the fraud. The digital evidence, because it's digital environment, the information is captured electronically and it is available to monitor the fraudster activities. And this would be really good where we can check the connection of the fraudster to the system, the IP address, the timing, the outcome, the flow of the transactions from different ports. And then we start to see the electronic storage is relatively inexpensive because now we can save all the transactions on the cloud for an achievable price. And this can help the auditor to download the data and start running the different analysis to discover the irregularities. The fraudster risks detection during the fraud act, and as long as the data is stored. So here there is a possibility if we are data analysts, or let me say data scientists, then we can be easily download the data and run the different tools to discover the fraudulent transactions. And if you are planning to take like some kind of further study in forensic accounting and fraud examination, there is plenty of tools in the market that can be used to do that. Stored data can be used to trace the transaction. As I said, we can check the IP, we can check all the messages, the emails that were happening between the fraudster and the other parties. And then we can see the approval through different emails or password or electronic signatures. And then we would be able to find the transactions. The value of information system, we generate red flags for further investigation, reconstruct the actual data flow, and provide strong evidence. And it comes by itself because usually every system has its own logs. And in the log, I can see all the transactions happening with all the portals. Even if some kind of hacking happening from somebody outside the company, I will be able to discover it. So the system itself will make a log that has all the unusual entries that might happen. And then potential for overwhelming number of fraud symptoms that's possible in the digital environment. We have to be clear and separate the transactions to make sure that we focus on our plan about the investigation. I'm not gonna discuss again the evidence, because here I start talking about the evidence, but in the next chapter, I will talk more in details about the evidence that we need to know how to collect a reliable evidence, relevant evidence, and timely evidence. And this is the second part that we need to know when we start talking about the red flags. So red flags are hints, tips, phone calls, emails that can help the person or the examiner to investigate the matters and see if it's true or false. I hope you find this short presentation about the red flags useful, and just giving you the basics of how to discover the red flag, how to analyze it, how to document it, and find the right evidence for. Thank you so much, and we'll talk later. Bye-bye.